This particular market is one of the largest markets in the country. Now, if you're not investing in it, say, you at least may have a home in it. If you're 5 million of the 25 million people in Australia, it does make an impact directly and indirectly to some other locations, because you've got 5 million households here in Sydney, but at the same time, you've got those households not just buying there or owning there, but potentially using equity to leverage and borrow against markets elsewhere. In this episode, we're going to actually do a deep dive on Greater Sydney, and we're going to look at the market via 10 particular charts. And that will help you in understanding how interest rates have and have not played an impact in certain markets, and in turn, help you look at the key charts to analyze to help you increase your improvement in the investment analysis space of property markets, right? Hit the like, hit the subscribe. Let's do it. Let's look at the 10 charts. Chart 1. Market performance metrics. So at InvestorKit, we use these 6 core metrics to look at an overall analysis of the market. And this is using the spider chart. So the first one is price pressure. This is essentially multiple indicators around days on market, stock on market, vendor discounting, housing inventory, all the things that make us say, oh, it's hot here or not hot here, faster selling, less discounting, these sorts of things. And as you can see, it's really starting to stretch out. And remember, the more it's stretched out, the better the score. So this is stretched out to 3, that balanced piece. And if this continues, this will keep going to 4 and 5. Rental pressure, this is as simple as vacancy rates, rental days on market. And we look at them from what we call a static and trending. So static being what's the percentage it's at today. Trending being where is it going to? And this is obviously quite strong. In migration coming into Australia, that's going to massively help and increase this data point even more. But it's here at the 5, and rents are increasing. And with these rents, it's something really important to remember on the topic of interest rates. Interest rates go up and down. Rents just typically go up. And if you draw a curve of long term, you'll see the rents just go up. So what that means is you might have a small moment of pain in cash flow, but if rents just keep going up and up, but you bought at the today price, the yield gets better. There are those in Sydney who might go 5 years ago, 10 years ago, 20 years ago and say the yields are low in comparison to others. But because of the rent increasing now, the yields are higher in comparison to the time they purchased. And that's what long-term investing is about. And this is a dynamic where it's really interesting, and I'm seeing this play out in Sydney and Melbourne. Don't be surprised if in the few years ahead, rents just keep increasing. A property you bought, say today, interest rates come down, positive cash flow. How long's it been since you heard positive cash flow in Sydney and Melbourne? But the truth is, it can occur with a bit of patience. So this is just something to think about for longer term. Now, rental yield, it's still quite low in Sydney. This is not a good score of Sydney. So you have to really be on certain incomes. Like, give you an example. I know these are huge numbers, but to be an investor of a house in Sydney at decent prices and something where you can scale a portfolio beyond that, probably got to be earning like sort of 200 to 500 or 500 plus even as a household, not just an individual. Now, many people watching these videos may be blown away by those sorts of numbers, but the truth is you just do a cash flow sheet right now, and there are some parts of Sydney where a home might be 1.6 million, renting at 800 a week, 900 a week tops, 750 even in some areas, and all of a sudden that's like 30, 40, 50 grand negative cash flow on interest only. And so what that means is these rental yields are low. Now, yes, the dynamic I told you will change over time. That's why rental pressure's there and rental yields here. But in comparison to other cities, unless you're on a really high income, it's not something that you can sustainably scale a portfolio with, or unless you bought a Sydney property some time ago. Affordability, this is a metric where we look at interest rates and then P&I loans, 30-year repayment terms, 80% loan to value ratios, and we see what the monthly figure is, like an actual repayment of a median Sydney house price. Now, this will change from area to area. Incomes will too. And this is where we grab the income of Sydney, and then we look at it from a household income and see how it stacks up against those repayments. So you have to be above average to really start to take on these sorts of mortgages. Then we look at incoming supply. So this is construction in the pipeline, both completion averages or looking at building approvals in the pipeline. These sorts of things benchmarked against the historic trends and larger sort of nation review. And it's not bad. Supply is still fairly low in Sydney. It's not obviously super low, but it's not balanced or kind of very high. It's not bad at all. Growth cycle, expect this trend to improve. You can look at it in one of two ways. You can say that last 10 years outperformed so much that Sydney's cooled down to make up for how much outperformed in 10 years. Or you could say 6 to 7 years of underperformance, the next 3-4 years will be better. That's the key ways to look at it from just long-term averaging. Remember, never use something in isolation, look at it overall. And this is where we see things happening. Demographic and economic trends. So I think the key thing is Sydney has been losing residents to other parts of the country, but this is not new, right? Sydney's always had pretty crappy internal migration. The overseas migration has been very solid, and we're seeing the rental markets explode as a result of that. And you can expect increased rents to continue because on average, migrants tend to rent for the first 4.5 years. This is a study conducted by the Grattan Institute, and this was some years ago, the study, but the trends are long-term and they'll likely stay. People, as you might think, don't actually come up with a bucket load of cash ready to buy houses when they land in Sydney. It's not how it works. There's dynamics of family, dynamics of community, dynamics of employment, dynamics of banking history, savings, income growth to match what's required. No one comes in and lands a seven-figure doctor salary the moment they start. These things take time. So I think maybe the thing that people get wrong again and again is thinking that everyone just comes off planes with truckloads of cash ready to buy everything. In small samples, there are a few people, but the majority of migrants are here to rent and they'll grow their families. This is something that's key to understand. So rent markets are likely to continue rising. Unemployment trends. So when looking at Sydney's unemployment, it's super low. We can see unemployment come down heavily, and we're also seeing the number of job ads spike over the years. But with this huge interest rate increase cycle, with migration coming in, my expectations are that unemployment should start increasing and job ads should start cooling off. They are still at brilliant and high levels, but expect this boom to not last forever on the job ads. And that is normal. Remember, it's all about the fine balancing out of unemployment, job ads, inflation, spending, and growth of the economy. And that's what the RBA has been trying to maintain. Sales market trends. So we can start to see the price recovery taking shape here, and we can also see days on market lifting, but we have noticed in the more micro data on the week by week, day by day stuff that we have some internal back end review on, we're seeing the days on market turn the other way. So you should see future releases, see this days on market fall back down and prices continue their recovery. Demand versus supply. So when we look at it, demand is measured as sales volumes, people doing deals. Deals is demand. And then listings is the key thing to look at from the supply. Now we use this measure called inventory, which is a combination of them both. And we're looking at what we call months of supply. So for example, if you have inventory here at about 2.8, it means that there are 2.8 months of supply. And so the power of this metric is that we've done a lot of back testing, and that sort of 2.5 to 3.5 number is a really healthy number because we start to see that it's either balanced when it's towards the sort of 3 mark here, and then it comes down to a tight level. So we're obviously seeing some things start to shift here, and we're seeing these recoveries occur because there's that imbalance between supply and demand, supply being lower and demand being higher. So sales volumes here are starting to lift. It's a subtle change, but we're starting to see that lift, and the new listings are still on the lower side. Long-term new supply trends. So from this perspective here, we're seeing long-term new supply really at pretty low levels. So what we do is we take the last 15 months of building approvals and we take it as a percentage of total housing stock in Sydney. And we're specifically focused on house. So houses are what we look at, not a unit or townhouses. And so with houses, they're at that 2% mark, or just a little bit under in terms of the percentage of incoming stock. We typically see up to that sort of 3% mark is balanced. And this red line is what we call the top quartile of high risk areas. So if you said all of Australia, you grab the top quartile, the top 25% of the areas that have the highest average of building approvals, what is their average? The average here is between 3.8 to 4%. So those are the markets that are showing higher rates of building approvals. Sydney, as you can see, is not there. So we're going to see an undersupply of Sydney in the years ahead from construction. In fact, we're already seeing it there now. Long-term price trend. So earlier I mentioned this. This is the part where I talked about, you can see here, the 10-year capital growth rates of Sydney, it outperformed, but the average of capital cities, it definitely beat. So 10 years, Sydney is lifting its game. But Sydney over the last 5 years, if you double that, it's only about 62%. It's below its 10-year averages or 40-year averages of the past. Capital city averages. So Sydney has just been an average performer. It's not an overperformer. So you can see that this could be something exciting here. If the trend continues, the likes of Sydney may start to see a growth cycle continue beyond just recovering now because it's making up those lost times. Or alternatively, it could be making up the slow period needed due to the boom that first occurred, right? Rental markets. This is the key part where rents will continue rising. Vacancy rates upticked a little bit, but they're still very low. You can see this 2% vacancy mark is a benchmark to say that a balanced market is present. At this moment, though, vacancy rates are very low and, in my opinion, expected to stay low for the next couple years. Rental yield trends. Right now, we've always known, history has always demonstrated Sydney as a low performer in rental yields. But those yields are improving because of the dynamic of price decline rent increases, and these yields are expected to continue improving as this chart trends up. Now, it will never catch the greatest capital cities average, but it will increase in comparison to its past. Right now, we've always known, history has always demonstrated Sydney as a low performer in rental yields. But those yields are improving because of the dynamic of price decline rent increases, and these yields are expected to continue improving as this chart trends up. Again, there are still other markets in the country that perform better from a rental yield perspective, which will probably allow a little bit more scalability in portfolio if you need it from an income perspective and if you aren't a very high income, affluent income earner. And the last part is the rental cycle. So nothing has outperformed the greater capital cities in the 10-year rental cycle. So this is something that many people forget. Many people think that the rents are rising simply because of the vacancy rates being low. Yes, that's the contributor. Vacancy rates being low increase rents, but they were always due to increase. A rental cycle here is demonstrated that in the last 10 years, we're only just getting back up to about a 30% 10-year movement, which in simple terms is saying that pre-COVID rent increases, you can see the explosion, we were well below long-term averages in both Sydney and Australia for rental increases. So it sounds pretty crazy, but we were actually always due for a rental boom. It's just that the dynamics of everything that occurred. And I think one thing that many people aren't taking into factor as much is that it's not just a vacancy for migration or shifts like that. It's also the dynamics of the global shift in household formation, demographics. And I had a gentleman by the name of Simon. I won't pronounce his last name because I'm going to botch it up, but he's from the demographics group and he produces some brilliant content. And he came on one of our podcasts on the Property Nerds. So if you're a property lover, data lover like this, check out the Property Nerds podcast. Hit the like and subscribe on that too, because once a month we release some detailed episodes on that. Now, with that data, he talked about household formation, which is the household sizes falling. And as household sizes fall, it means it's the same people spreading across more houses, meaning more households are created without any new people in Australia entering the country. This was a massive shift because overnight, instantly, as these dynamics occurred and millennials started forming their own individual households and household sizes started shifting down, we were always due for a rental boom over this decade. So from that perspective, the key thing is that this was always going to happen. It's just all the factors of COVID and all the cheap money and other things and the slingshot of pausing, starting something, supply shift dynamics made a big impact suddenly. But it was always going to happen this decade, whether you believed it, liked it or not. And this is where rental markets can improve further because they're still below long-term averages. And this will improve the positioning of Sydney from its cycle. So what do I expect over the next 6 to 12 months with these 10 charts being analyzed? Well, Greater Sydney will have a strong recovery in overseas migration. Its local economy is very solid and recovering confidence is definitely showing in improving clearance auction rates. I believe that the Sydney house prices will continue lifting over the next 6 to 12 months. However, it's now surpassed peak values, so the milder rate of growth will start to kick in eventually because this cycle needs to truly be tested if it's a new one continuing and it's that 10-year shift I talked about, or if it's just going to mildly come off now after it's made up that recovery like it did in 17 to 19, then 2021, and then 22. This constant zigzag. From there, if the current signs continue to show that the RBA cash rate will truly stop hiking and even decline, and we're seeing now the strengthened consumer sentiment, it will push these rates at a higher rate. And Sydney does have a higher sensitivity to credit markets. Sydney's always been sensitive to major credit changes. It's the financial capital of Australia. So I feel like from that perspective, it just has more sort of sensitivity to that, banking industries, finance shifts, and the finance required in Sydney, as you saw from affordability for leverage and new houses, these things make a difference. And so I think with these pauses, they've just added consumer sentiment to even improve. And that should mean that the cycle continues. And then it's really just a test of if that interest rate starts starts to taper off a little bit more, or even positively put on a further fire to it in Sydney, and the unemployment rate will be the next one to watch in terms of the economy. But for now, expect this to continue, and then from there, we'll see if this new cycle emerges or not. If you bring that all combined with our own internal metrics, you can see that Sydney is balanced, and if this recovery continues ahead, then it moves into a higher pressure status, which is looking likely at this stage. This is the first of our market pressure deep dives. Hit the like, hit the subscribe, drop me a comment if you want, and we will be able to show you more content like this, with the next one being Melbourne. So keep an eye out for that video.